Why you always buy the top and sell the bottom. Welcome to Market IQ Basics. If you have been trading for any length of time, you have probably noticed a pattern. You watch a setup develop. You wait. The price moves. You wait a little longer because you want to be sure. Then you enter. And almost immediately, the market reverses. You hold on, hoping it comes back. It does not. You exit at the bottom. And then you watch the price go exactly where you thought it was going, without you. This is not bad luck. This is not the market targeting you. This is psychology. And once you understand it, you can start to fix it. Why this happens? The confirmation trap. The human brain is wired to seek certainty before acting. This served us well as a species. Acting without enough information in a dangerous environment could get you killed. Waiting until you were sure, until the threat was confirmed, was the safe, rational choice. In trading, that same instinct destroys accounts. When price is building toward an entry point, the brain feels uncomfortable. There is uncertainty. The setup looks right, but it has not confirmed yet. So the brain waits. It wants more evidence, more candles, more momentum, a stronger signal. And price obliges. It moves. Now the brain sees confirmation. The move is real. Now it feels safe to enter. But here is the problem. By the time price has moved enough to feel safe, by the time the confirmation the brain demanded has arrived, the move is often already largely complete. You have not entered at the beginning of momentum. You have entered at the end of it. You bought confirmation. And confirmation in markets is almost always expensive. The psychology of chasing. When price moves without you, something specific happens in the brain. The same FOMO mechanism we discussed in the overtrading video activates. The brain registers the missed move as a loss, even though no money changed hands. That psychological pain is real, and the way the brain resolves it is by pushing you to act, to get in, to not miss any more of the move. So you chase. You enter above your original level. You widen your stop to accommodate the new entry. Your risk to reward, which was solid at the original level, is now poor or non-existent. But the brain does not care about that calculation in this moment. It cares about the pain of being left out. And entering the trade makes that pain stop until the market reverses. Why you sell the bottom. The exit is driven by a different mechanism, but equally powerful. When a trade moves against you, the brain enters a threat state. The loss feels like danger, and the natural human response to danger is to eliminate it, to stop the pain as quickly as possible. This is loss aversion in action. The brain does not think this is a normal pullback within a valid trade. It thinks this is a threat and it needs to end. So you sell at the low. At exactly the moment the selling pressure is exhausted and the price is about to turn. You did not exit because your system told you to. You exited because your nervous system told you to. And your nervous system does not trade well. The cruelty of markets is that they are designed, not deliberately, but structurally, to exploit these exact tendencies. Retail buying clusters at highs because that is where confirmation lives. Retail selling clusters at lows because that is where pain lives. The market moves through those clusters and then reverses. every time. What to do instead? The solution is not to feel less. The solution is to decide before you feel. The first tool is the pre-planned entry. Before the session, when you are calm and the market is not moving, you identify the exact price level at which your system says to enter. You set a limit order at that level. When price reaches it, the order fills, whether you are watching or not. The decision was made without emotion because it was made before emotion arrived. This one change, moving from market orders entered in the moment to limit orders placed in advance, eliminates the confirmation trap entirely. You are not waiting to feel sure. You are trusting the analysis you did when your brain was clear. The second tool is a non-negotiable stop loss, placed at the time of entry, not after. Not a mental stop. A real order in the market. This removes the exit decision from your emotional brain during the trade. The system decides when to exit a losing trade, not the pain in your chest when the position moves against you. The third tool is defined targets. Know where you are taking profit before the trade starts, not when price is flying and the brain says, let it run, before. Greed is as dangerous as fear in markets, and it activates at exactly the wrong moment. The fourth tool is reviewing your entries. Pull up your last 20 losing trades and measure where you entered relative to your original planned level. The data will show you exactly how much the chase costs you. Numbers change behavior in a way that intentions never do. The core principle: the market rewards patience and punishes urgency. Every time. Buying the top and selling the bottom is not a skill failure. It is a human failure. The completely normal result of letting ancient threat response systems make modern financial decisions. The fix is not to become emotionless. The fix is to make your decisions before the emotion arrives, and then trust them. The plan you make when you are calm is almost always better than the decision you make when you are afraid. At MarketIQBasics, we are here for the whole journey, especially the parts nobody talks about. If this helped you understand your own trading a little better, please like, subscribe, and share it with someone who needs to hear it. See you in the next one.